Everyone, and welcome to Chart This with Dave Keller. It's Thursday, September 19th. We're coming to you live from a beautifully sunny but comfortably cool Redmond, Washington. My goal after the show is to go for a hike through the woods, try to decompress after this raging bull market phase that erupted today. Yesterday on the show, we talked about sort of the buy the rumor, sell the news, which is what it certainly felt like going into the close, right? You had that gap higher as the Fed announcement occurred yesterday, 2 p.m., 2:30 p.m. to 4 p.m., all about distribution, ending up back down, basically flat to slightly down for the day. This morning, before the U.S. market opened, you saw the futures gapping higher in a pretty big way. The equity session did not disappoint, with the NASDAQ up almost 3% at one point in the day. It settled down to still be up 2.5%, but is a very much risk-on feel to the tape today. Some of the growth sectors like technology, consumer discretionary, really getting it done. Only 3 of the 11 S&P sectors in the red. Is this the beginning? Is this the launch pad of the next big bull market phase? Or is this a fake rally? Is this a head fake as buy the rumor, sell the news, maybe delayed by a day or two? Interesting competing narratives right now, right? And I was doing an interview earlier today and was asked about some of the different narratives, sort of macro themes going on. And I would say there's an interesting competition between an election season that is highly contested, between the Fed and a rate cut cycle, of which many of us have not experienced too many of these, and certainly not with the aggressive start that we saw earlier this week. Geopolitical issues that are just very, very close from escalating to the point that they could really impact risk assets. A lot of things to think about. We haven't talked about companies and what they're actually earning and stuff like that. That's sort of way down the list of things, but still with very much market moving potential. With that in mind, let's look at the charts today, see how things played out here. So the S&P 500 finished the day up 1.7%. It was actually a decent up day as all was said and done. Now, the most of that, I would say the bulk of that move came with the gap higher in the open, right? We did drift higher through the course of the day, but the afternoon, after about 2 p.m. Eastern, settled down quite a bit. We ended up pretty close to the U.S. Open looking at the S&P 500. So think about that, right? What happened before the open versus what happened during the live trading session? The gains occurred the gap higher, right, is sort of the optimism that was, a part of the pre-market session. The futures trading pretty high, so we have that higher open. But we didn't see a bunch more of accumulation into the close. We certainly saw it through the afternoon, but in the end of the day, you saw actually pretty consistent selling from around 2 to 4 p.m. Eastern. S&P still up, closing above 5,700 for the first time, up 1.7% from Wednesday's close. The NASDAQ composite outperforming, closing above 18,000. That's 2.5% above yesterday's close. The Dow closed above 42,000. That's up 1.25%. Mid caps, small caps, both up as well. The S&P small cap 600 index up about 2%. So outperforming the S&P 500, not quite as strong as the NASDAQ. All that strength, all that gap higher really settled down volatility on yesterday's show, and really for a while now, we've been tracking the VIX, talking about that 20 handle as a key sort of back of the envelope level. Generally speaking, VIX below 20 is a low volatility, low uncertainty, low fear kind of environment. VIX above 20, well, it doesn't necessarily mean the end of the world. It certainly means something is happening that you need to be aware of. And that's why I often coach people, if you know nothing else, like put an alert for when the VIX is over 20, maybe ping it to your cell phone. Go do something else for a while. And once it hits that, that's the reminder that, okay, things are happening enough that you probably need to be concerned. Otherwise, it's just not getting that uncomfortable. But down around 16.2 at the close today. That's down a full 2 VIX points from Wednesday's close. Looking at some other asset classes here, you can see interest rates sort of middle to the long end of the curve, drifting higher today. You can see the 10-year yield around 375, the 5-year point just above 3.5%. The long bond over 4% here, about 4.08, 4.07, we'll call it. What's interesting here, the short end of the curve, of course, coming down a bit. That's where the Fed, when they lower rates, that's really the short end of the curve that they are manipulating. And I don't mean that in a negative way, but just actually what they're doing. They're changing that level. But then all the other rates are about forward expectations, about economic growth and the conditions going forward, right? So that's why the yield curve in a lot of ways is sort of a forward-looking mechanism on expectations for rates, which is why that inverted yield curve, right, where the short end is above the longer end, kind of gives you an idea of what bond investors are thinking in terms of future expectations. They're seeing an economy shrinking. They're seeing less opportunity for growth as a result. Longer duration bonds have a lower yield. Now, all of a sudden, we're starting to get back to that more normal shape yield curve, which is what the market should look like, what the yield curve should look like if we have a growing economy and for sort of have optimism for the future. So certainly starting to right itself. What you have to remember is if you look back in market history, that yield curve being inverted for a while and then getting back normal, that doesn't just mean that stocks kind of rip to the upside. To the contrary, stocks actually sell off often after that initial, after that sort of righting of the yield curve. But over time, they tend to appreciate. And I often remind people when they ask about shorting into the strength here, I get the argument, and I've dabbled occasionally, not with directly shorting individual names in my own portfolios, but I have used inverse ETFs and leveraged ETFs at times to express a particular investment thesis, a particular point of view. But what you have to remember is betting on the markets as a whole to go down can be a very profitable approach if you use it on a limited period of time. The longer your runway, if you look at market history, the less and less likely, and eventually there's a 0% chance you're going to make money in a long held short position, because generally speaking, the markets tend to go up. So shorting, betting against the long-term trend, can be a profitable short-term strategy. It has really never been a profitable long-term strategy for the markets as a whole. Now, individual companies can go bankrupt. They can go out of business. They can certainly go to zero, and that is a different thing altogether. But when I talk about people, with the overall trend in the market, keep in mind the trend in stocks over time has basically always been higher. Having said that, it's not just stocks getting it done today. Worth noting, if you're thinking gold is a safe haven, silver is a safe haven, you just have to wait for stocks to go down for those to rip higher. 2024 hopefully convinces you that that's not always the case. Today, with the S&P making a new all-time closing high yet again, gold also making a push to the upside, up 1.5%. Silver, using the SLV ETF, up over 3% today. Natural gas, crude oil, all of these moving to the upside. So the commodity space moving higher. Gold, and can be thought of as a safe haven, but the reason why I think a lot of people have that narrative in their head is not because they move inversely, right? It's not if stocks go up, gold goes down, or if stocks go down, gold goes up, although that has happened at times. It's more about the lack of relationship, right? There's a very low correlation, and it's very fluid between stocks and gold. So the chances of gold doing something different are actually pretty meaningful. And that's why I think it can be a good diversifier overall. All the commodity ETFs that we track in the green today. Also a lot of green in the cryptocurrency space. Bitcoin finally having a pretty decent update. We haven't had a lot of these recently. Bitcoin's been sort of languishing, but the optimism for stocks really fueled optimism in the cryptocurrency space over the last 24 to 48 hours. You're seeing Bitcoin currently above 63,200. Ether prices approaching 2,500. Those are up about 2 to 4% from yesterday. All right, let's look at the 11 S&P sectors. And I appreciate, by the way, I see some of the questions coming in. I can monitor questions that you're putting in, whether you're watching us live on YouTube, on X, on Facebook. Put comments on whatever platform you're looking at. Love seeing what you're seeing and what you're thinking relative to some of the charts and insights that I'm sharing with you. Time permitting, I'd love to bring some of those questions on and have a bit of a conversation here virtually. All right, looking at the 11 S&P sectors, you can see 8 out of the 11 were in the green. So this really was sort of a risk-on day within sort of a choppy sideways period here. The technology sector, XLK, your top performer, up almost 3% today. Consumer discretionary, the XLY, was up 2.3%. Industrials, third from the top, up 1.7%. Only 3 of the 11 sectors down. Utilities, consumer staples, and REITs all finished lower. Not end of the world lower, but certainly not positive. And it's worth noting that those are probably the 3 most defensive sectors out of the 11: Utes, real estate, and consumer staples. And the fact that those defensive sectors have been doing so well in recent weeks and months has been one of the things that has caused me to be hesitant to think of significant further upside in this environment. For one day here, getting a bit of a mean reversion where some of those defensive sectors are pulling back a bit, some of the growth sectors that have been lagging, like technology, actually having a pretty decent update. I think the real question for the bulls in the room is this just the beginning, right? You need more days like this where growth leadership is reexerting itself. I would argue for the benchmarks to have meaningful upside, I mean, significant market impact sort of upside, you need to have the Magnificent Seven stocks breaking out, pulling a Meta, as it were, because Meta actually had a pretty decent update. Speaking of Magnificent Seven stocks in the green, you can see Tesla up over 7% today. That's one of the Magnificent Seven stocks, probably with one of the more stronger trends here in the last 6 weeks or so. Nice trend channel of higher highs and higher lows. Nvidia, Meta, both up almost 4% today. Alphabet was your worst performer of this group. It's still up 1.5%. Yesterday, we went through those Magnificent Seven stocks and grouped them by pattern. So if you missed our Wednesday show, check it out on our YouTube channel. You can reflect on that. But really interesting exercise to group them by the types of patterns you're seeing, then take a step back and see what that means. And I would say recognizing which ones are working and which ones are not within any sort of group of charts can be a really valuable way of using technical analysis to help you differentiate A to B to C, you know, which are the best opportunities, which ones not so much. Finishing off here with the market carpet, and I do want to show you that overall, pretty strong day with a lot of green on here. And so, step one, let's look at the areas of the market we're seeing some of the brightest green. In the upper left corner, you have Apple, Nvidia, Broadcom, three of the biggest technology names. Microsoft's still fine, but not up as much. Seeing a number of semiconductor names like an AMD in there, seeing Salesforce up over 5%. So a lot of these are pretty good upswings. Again, within a sector that has not been particular leadership. Where are you seeing less green, right? Given the fact that it feels like everything felt like it was sort of up, where are you seeing less of that? A couple things that stand out to me, and I would encourage you to look at something like the market carpet on stock charts, something like FinViz has some really good visualizations, heat maps like this that help you make sense of a bunch of stuff and help you focus on the more actionable ideas. Within the financial sector, Visa and MasterCard, these have been two of the better sort of charts emerging within financials. A lot of things have been looking pretty good, but Visa and MasterCard really started to improve there recently, pulling back a little bit here today. Healthcare with a much more mixed sort of measured result. Compare like this look to the look you see in technology. You can see healthcare obviously lagging behind. Consumer staples, real estate, utilities, those are those three defensive sectors that were actually down today. If you look, a lot of these stocks actually had a rougher session today. Now, these are some of the areas of the market that have been the strongest in July, August, now into September. So again, this is one day. So I don't like to draw too many long-term conclusions from a heat map like this, right? Remember, draw long-term conclusions from long-term data, make short-term decisions with short-term data. That's tip of the day in terms of how you think about these markets. I do want to quickly share a poll. We actually had a poll going on our Twitter or X account earlier today. Basically asked about Meta. Meta was, pushing above 540, and we highlighted on yesterday's show how Meta, while encouraging in the short term, really had not been able to power through that level of resistance. It happened today, right? And earlier in the day, we shared this and said it did get above 540 this morning after months of failing to do so. Is this a good breakout, implying that there's much further upside to come? It's just the beginning. Or is this going to be a failed breakout where selling this strength and betting on a whipsaw is the more optimal idea? 62% of people that responded in the poll said this is a good one. You want to follow Meta to higher highs and higher lows. Only 38% of you said, boo, it's a failed breakout. Let's look at the charts here with S&P. We'll get to Meta and others as we continue on here with our show. Here's the daily chart of the S&P 500, and now we are literally in uncharted territory, pun very much intended, as the S&P closes above 5,700 for the first time. A lot of firsts coming in 2024 as the S&P and the NASDAQ pushing to new all-time highs. I think this is a pretty important development because that 5,650 level has been pretty important. That's where we hit in July, and then we pulled back into the August swing low. That's where we hit in late August before pulling back into the early September low around 5,400. Now we're all of a sudden making a higher high for the first time since July. Earlier this week on Tuesday and Wednesday's session, we had traded above 5,650, but closed back below. So that really showed some indications of short-term distribution. Even though we were trading higher, sellers were coming in and pushing the price back down. Today, the gap really propelled the S&P to its new high. So anytime you have a clear level of resistance and you have a break, I would say this is now completed two of the three steps of any technical pattern. Here's another tip of the day, I guess. Tips of the day is now what I have to call these. From a technical perspective, anytime you have a level of support or a level of resistance, I think there are three things you're looking for. Number one is what I call the setup, right? This is where the chart has a particular look. This is where you can start to see 5650 is an important level, right? And I would say, right around here in sort of late August, it became clear that 5650 was a meaningful level for the S&P because we essentially had a double top. We had a number of attempts to get above that level and had not really blown above there. The second part of that pattern, second phase you're looking for is the trigger. And I would say every pattern, every level has a trigger. That's an actual confirmed close through the point, right? So intraday moves through that point are not enough. Finally, closing above 5650, which we finally did today, I think completes that second phase, which is the trigger, right? Check. The third phase, which I think we now look for on Friday's session into the beginning of next week, is what I call follow through, some sort of confirmation, some indication that it isn't just a one-off thing and that there's further accumulation, that investors are willing to pay more than 57.15, 57 and change for the S&P 500, essentially. This is vital, I would say, and particularly now where there's a lot of skepticism about further upside from me and others that just see signs of divergences, signs of lack of volume, signs of weakness underneath the hood with defensive sectors doing well. You need that third piece, which is confirmation. So I think tomorrow into the beginning of next week, do we have further upside? We have at least an additional move in that direction, sort of confirming that today was not a fluke, but the beginning of further accumulation. That's what I'd be looking for here. But for now, hey, the breakout is the breakout, and it happened. Now, some interesting things happening here, and I'll show you some charts to continue on with the show. When we talk about breadth conditions, I would say remember that breadth is all about measuring participation, right? How many stocks have a certain configuration. And this is the S&P 500. At the top here, I have a series of other breadth indicators and other sort of sentiment reads that I like to have. I'd focus your attention on a couple of these. The percent of stocks above their 50-day moving average is now above 80%. It's getting up to around 85%. 85% is that red horizontal line that you see on my chart. That is sort of a warning sign, right? We get above 85%. If you go back in market history here, particularly recent market history, that's usually been a sign that the market is overextended. Now, why would that be? When the market's going higher, you want to see more and more breadth. And that's what we've identified, right? We've been talking about the fact that breadth has actually remained strong here in the third quarter. But the question is, how much breadth is too much, right? Or how good is too good? When everything's going up, all of a sudden that gives you more of a euphoric sign, not sort of a gently optimistic with more upside potential. All of a sudden it gets too euphoric and you start to worry about whether there's a sustainable move in the cards if all of a sudden everything's going up, because then at some point profit taking starts to feel really good to investors that have participated in that next leg higher. We're getting really close on this particular indicator. You often have a pullback once we get back below that 85% level. So I think that's an important chart to watch. Also, as a reminder, the bullish percent index on the S&P 500 did break above 70 in the last week. That means 77% now of the S&P 500 members have a bullish point and figure chart. And above 70, for me, is sort of that red flag. We look for a break below 70. And again, major pullbacks have usually been marked by that indicator going above 70% and then back below. Last time we saw that was in late July, which sort of led into that August pullback. So another chart to pay attention to. Survey data, sentiment data often comes out on Wednesday into Thursday. We're starting here with the AAII survey. This is a weekly survey of individual investors, basically saying, how are you bullish, bearish, or neutral on stocks for the next 6 months is basically what they're asking. With today's report, which came out earlier today, over 50% bulls. And while that's not the highest rating you're ever going to find, it does sort of get into that euphoric category. So we talk about euphoria in terms of breadth with most stocks above moving averages or most stocks in a particular bullish configuration. Here we're actually looking at survey data, what I call sentiment data. And when too many people are bullish, all of a sudden that tells me, as my contrarian alarms goes off and tells me, okay, if everyone's bullish, who's left to buy, right? Who's left to push it higher? And Tom DeMark, years ago, when I was working with him closely, used to say the markets would top out because of an exhaustion of buyers, right? The last anecdotal buyer has bought, no one's left to push it up. And so the AAII survey getting above 50% is one of those kind of general things I would look for. Doesn't necessarily mean the top is in. Again, what it tells me is to look for signs of distribution, look for signs that investors are selling into strength as opposed to buying strength. And that's what we'll be looking for looking at the charts. The name exposure index, which are the black bars, the black histogram that you see at the bottom, is a weekly survey of money managers, basically saying what's your allocation to the equity asset class. As of this week's report, 87.5%, to call it 87%, allocated to equities. Last week, it was just above 70%. About 6 weeks ago, during the August low, it was down around 55%. So in the last 6 weeks, we'll call it, we've gone from 55% to almost 88%. When we get above like 90, and really when we get above 100%, so it's not quite there, that euphoria level for me is above 100%. If you look back in the course of 2024, times when we've been above 100%. Here we go at the July peak, just a week before that topping pattern leading into the August pullback in March, which was leading into the drop in early April. So when we get above 100% allocated, I'm looking for signs of distribution, looking for signs that investors are selling that strength, and I'm starting to see us get close to that level. Over 100% here in the next week would be the level I would be looking for. This is a chart looking at relative performance of different sectors. And these are the three kind of classic growth sectors that I would show you. The reason I want to show you this is while technology had a really strong day, top performing day today, on a relative basis, it's still not that impressive, right? So this is a ratio of the XLK, the technology sector, versus the S&P 500 index. Look at how that's still, even with the bounce that we've seen in the last week or two, still underperforming from early July. The communication services sector, which has bounced here in the last week, still down below where it was in early August. The only one of these three that I would argue is really starting to impress is the consumer discretionary sector, right? The sector with Tesla and Amazon and Home Depot and home builders and a bunch of other things that are starting to look pretty good. This is a ratio looking at the consumer discretionary versus consumer staples sector. And what I love about this particular chart is that it's a relative measurement of offense over defense, things you want over things you need. When conditions are good, when investors are confident, when consumers are nice and happy and they have money to spend, they tend to buy discretionary goods, things you don't necessarily need, but that you want. A new car, nice clothes, a cool watch, travel, tourism, those sorts of things that you don't need, but boy, they tend to make life a little more sparkly, I guess. Consumer staples are things you need. No matter what's happening in the economy, no matter how much money you probably have, you're still going to want to pay for shelter and food and household goods and cleaning products. Those are things you would kind of always need no matter what. So by looking at things you want versus things you need, which is what this ratio is telling us, how confident are consumers? And while we can talk about consumer confidence as an economic measure, I would argue this ratio is much better because it's based on price action and how investors are actually voting with their capital. Investors have been voting with their capital over the last 6 weeks very much in favor of the things you want, consumer discretionary versus things you need. Now, this was not the case going into the August low. You can see that both of these ratios were actually rotating lower in a big way, but in the last couple of weeks, you're seeing a nice rotation to the upside. Now, arguably, a lot of this is driven by Tesla, up big today again, like Amazon hanging in there okay, like Home Depot, like other home improvement stores, home builders, all in the consumer discretionary sector, and all looking quite strong on a technical basis. Remember, the bottom panel here is equal weighted, so it takes the Tesla, Amazon overweight off the table, and it's just looking at kind of the average consumer discretionary versus average consumer staple. And as you can see, the chart's looking pretty good, and we're rotating to the upside. We asked that survey question on our Twitter feed about Meta, and I would say the chart of Meta is an important one here because we've been highlighting this level around 540 for months. I've written articles on this. I've done videos on this. I keep revisiting the fact that how great is a chart like Meta if it's unable to get above resistance, right? When you look at a chart like this, until it breaks out, at the best, it's kind of a meh chart. Or as Carter Worth, who I used to follow quite a bit in my Fidelity days would say it's a pair of twos, right? It's like, how great of a hand is this? It's like, it's not bad, but do you really want to bet the house on that sort of chart? Not really. Is this changing now with Meta getting above 540? I think it might be. And I think the fact that a chart like this is finally breaking out is super meaningful. Ralph Acampora used to quote the great Alan Shaw, the late Alan Shaw, unfortunately, and say, the broader the base, the higher in space. The longer that a chart remains in this sort of sideways consolidation pattern, the more a breakout can be super meaningful, and arguably the more upside to be had once that breakout is finally confirmed. And I think that last word is important. We talked about the S&P and that break higher and whether we get confirmation tomorrow going into next week. I think the same thing could be argued for a chart like Meta, sort of breaking above that key level, and see if it can be the case. That's it for our charts. I do want to share a question coming in. I have a number of questions asking this particular theme in different rephrases. And thanks so much, Titus Ryder, for asking. Maybe this is the blow off top. I have people asking, do you buy this? Should I be buying puts? Of course, I can't make recommendations. I appreciate you wanting to ask me something like that. I have to say, I can't say for sure. But what do you do in this environment? I appreciate that this is what we're all thinking, right? That's the key question here. So, couple thoughts on this, and I would say to wrap up the show, right? We have competing narratives, right? And I would say there are still so many risks out there that are still very difficult to quantify, right? And I think that's what you have to remember as an equity investor, right? When you're taking risk in your portfolio, you are exposing yourself to a lot of unknowns. We don't know what's happening. That's why it's not a known outcome. It's a risk, right? It's the potential that something could happen that you don't want to happen or you don't think would happen. That's what risk really is. And if you buy the S&P or if you buy an individual stock, you are exposing your capital to risk. You have upside potential. You have the chance to make money, but you also have the opportunity to lose money. It's like gambling in a casino, but with better charting, I would argue. So what do you do in this environment? I think you have to remember there's a non-zero risk that geopolitical conditions escalate quickly. And we've seen that in the last week with events in the Middle East, events in Lebanon now. And I'm certainly concerned about the fact that it's had limited impact on equities to date, given, again, I think made clear by the fact that the S&P is making a new all-time high in the last week in light of all the events that we've seen. But it would not take much with something like that for the U.S. to be drawn in as a player. And think about what that would mean. That most likely would weigh on risk assets pretty quickly. And again, it may have a limited impact, but it's the uncertainty. The markets like certainty; they don't like uncertainty, and that's a big one. The second thing would be the election season, right? It's a contested election instead of being a very clear-cut outcome, which it felt like 6 to 12 weeks ago in the U.S. Now all of a sudden it's more contested. What do you own in this sort of thing? I'm not super comfortable just taking the S&P 500 and riding that higher. Although as long as the price goes higher, I don't mind doing that. But it's not where I see maybe the most opportunity, which you have to remember, and this is what I'll leave you with today. Maybe I'll tease this out in days to come. Under a Trump presidency, there are certain stocks that you probably assume would do pretty well. Under a Harris presidency, there's certain things that may do better, things like green, renewable energy sorts of things. Maybe traditional oil companies, right, would struggle in that environment. I would be focused on the things that are probably going to do better in either case. Things like investing in infrastructure in the U.S., which is sorely needed, and all of them, as mentioned, is going to be a high priority. I think that's going to be a big one. Home builders and other things that benefit from lower interest rates, consumer goods that are going to become less expensive, particularly expensive things you might have to borrow money to buy. Those are areas of the market that I think are probably going to do well. So I think the upside for the S&P is limited as long as those magnificent 7 stocks remain more range bound. If you're looking for opportunities, I would be looking for things that are probably going to do well regardless of who is elected. It's not a sure thing, but it's certainly something that would give me a little more confidence. Folks, that's it for our show today. Thanks for joining me here every weekday after the close for Chart This with Dave Keller from Redmond, Washington. Thanks so much for joining me, and have a great night. We'll see you again soon. Bye now.